Earlier this year, recession odds hit 40%. That number did not come from Reddit. It came from Goldman Sachs, JPMorgan, and Moody's analytics. Markets have since calmed. The headlines moved on. But here is what did not move: the math underneath your savings account, your job, and your home. Most people think a recession is one thing: a stock market crash, a wave of layoffs, a housing collapse. But a recession hits your portfolio, your paycheck, and your property at the same time through completely different mechanisms. And most people only understand how when it is already too late to do anything useful about it. So today, we are skipping the theory and running the actual numbers. What would a recession do to your high-yield savings account? What happens to your job? What actually happens to your home? Not vibes, not fear content, real math. This is the wealth metrics, real numbers, no noise. Let us get into it. If you are the kind of person who runs the numbers before something happens instead of after, this channel was built for you. Hit subscribe. Now, let us keep going. As of late June 2026, the best high-yield savings accounts are paying around 4.01 to 4.15% APY. If you moved your money out of a traditional savings account, give yourself credit. The national average at big banks is still sitting at 0.38%. On a $30,000 emergency fund, that difference is over $1,000 per year, just sitting there. But here is what a recession does to that 4% number. The Federal Reserve has one primary tool when the economy starts contracting. It cuts rates, fast and hard. As of June 17, 2026, the Fed held its benchmark rate at 3.5 to 3.75%. In a recession, that rate heads toward zero. History is not subtle about this. When the pandemic recession hit in 2020, the Fed cut to effectively zero within weeks. High-yield savings accounts that were earning 1.5 to 1.7% collapsed to 0.4 to 0.6% by mid-2020. Run that against today's numbers. In a mild recession with 2 or 3 cuts, forecasters project HISA rates fall to 3.5 to 4%. Moderate recession, 2.5 to 3. Severe zero-rate environment, like 2020, under 1%. Under 0.5. That is not a small shift. And there is a second force working against you at the same time. In May 2026, the Consumer Price Index came in at 4.2% year over year. That is up sharply from 2.4% in February. So here is where the math already stands before any recession even begins. If your HISA is earning 4.15% and inflation is running 4.2%, you are already losing purchasing power in real terms. Today, a recession would cut your rate while potentially sustaining or accelerating inflation. The squeeze comes from both sides simultaneously. Now, what about your invested money? According to Federal Reserve data, the S&P 500 fell nearly 57% from its October 2007 peak to its trough in March 2009. A retirement account sitting in broad equities got cut by more than half before the recovery even started. The COVID crash was faster, but recovered in months. 2008 took years. The shape of the recession determines the shape of the recovery, and nobody rings a bell at the bottom. The key distinction that matters for your HISA: FDIC insurance protects up to $250,000 per depositor per bank. Your principal is safe. It is the yield that shrinks. That is the actual risk you need to plan around. Your income is the engine everything else runs on. Your savings rate, your mortgage payment, your ability to invest, all of it starts with your paycheck. So let us look at what recessions actually do to jobs. The numbers from past cycles are more specific than most people realize. Before the Great Recession officially started in December 2007, the national unemployment rate was 4.5%. At its peak in October 2009, that number hit 10%. The unemployment rate more than doubled in 18 months. At the worst stretch, from October 2008 through April 2009, an average of 700,000 American workers were losing their jobs every single month. Total job losses reached 8.7 million, and recovering those jobs did not happen quickly. It took until mid-2014 for the economy to get back to the employment level it had when the recession began. More than 5 years, just to get back to zero. But job loss is only the first hit. The earnings hit is what stays with you longer. Research from the Hamilton Project tracked workers who lost jobs during the height of the Great Recession. Before their layoff, they were earning roughly $3,640 per month. In the 2 years after, even those who found new work did not fully recover that income level. Workers who moved into a different industry saw earnings losses double those who stayed in the same field. That scar can persist for years after the recession officially ends. Now, where does 2026 stand? The national unemployment rate is holding at 4.3% as of mid-2026. The private sector added 62,000 jobs in March. Pay for job changers was up 4.5% year over year. The surface looks fine, but the hiring rate has slowed to near recession lows in some sectors. Not layoffs yet, but a warning light. Here is something most recession coverage skips over entirely. Recessions do not fire people evenly. During the Great Recession, healthcare and education added jobs every single year, even at the worst point. Government employment held relatively steady in the early phases. Construction, finance, manufacturing, and retail were hit hard and fast. Hospitality was devastated. These patterns have been consistent across multiple downturns. The COVID recession was different in shape, but not in principle. Remote-capable knowledge workers were largely shielded. In-person service workers absorbed the first wave. So the most useful question you can ask right now is not whether a recession is coming. It is which side of this line your job sits on. Is your industry discretionary or essential? Is your role revenue-generating or a support function? Are you 10 years in or 10 months in? Seniority is not a perfect shield, but it is a real one. Entry-level and recently hired employees are historically the first to go when headcount reductions start. And the number that matters more than any headline unemployment figure: how many months of expenses do you have in liquid savings right now? In a recession where unemployment can stay elevated for a year or more, 6 months is the floor, not the goal. After 2008, the average duration of unemployment stretched well beyond 9 months for a significant portion of displaced workers. 3 months of savings sounds responsible. In that environment, it is a slow-moving crisis. If your industry is cyclical, construction, finance, manufacturing, retail, 12 months of expenses saved is not overkill. It is planning. Now for the topic everyone in 2026 seems to be quietly anxious about. What actually happens to home values in a recession? Here is where the conventional wisdom gets it wrong more often than it gets it right. During the 2001 recession, national home prices rose. During the 2020 pandemic recession, home prices surged. Within 2 years of the recession starting, national values were up roughly 40% above pre-pandemic levels. Recessions and housing crashes are not the same thing. The historical record is clear on this, but there is one massive exception, and it has permanently distorted how most Americans think about housing risk. 2008. The Federal Reserve documents that home prices fell by over 1/5 nationally between the first quarter of 2007 and the second quarter of 2011. It took until 2018 for prices to finally exceed their 2006 peak. 12 years to get back to even. Las Vegas saw prices fall by over 60% from peak to trough. Dallas and Denver held much better, with declines below 10%. But here is the context that changes everything about how you interpret those numbers. 2008 was not a recession that happened to hurt housing. The housing market was the cause of that recession. Subprime loans, no documentation mortgages, loans for 125% of home value, speculative buying fueled by the assumption that prices would never stop rising. When the lending system itself collapsed, housing collapsed with it. That is a fundamentally different dynamic than a standard economic downturn hitting the real estate market. So where does 2026 actually stand? According to Cotality, national home price growth slowed to just 0.9% year-over-year as of early 2026. Nearly flat. JPMorgan projects prices will stall at 0% nationally in 2026. Zillow projects about 1.2% growth. Redfin lands near 1%. These are stagnation projections, not crash projections. The structural floor under today's prices is a national housing shortage, estimated at 3 to 5 million units. That shortage does not evaporate in a recession. Housing takes years to build. Supply constraints provide real price support. Lending standards today are also dramatically tighter than 2008. Borrowers went through real income and credit verification. They hold significant equity cushions because prices ran up hard in the early 20s. Foreclosure filings have been rising in 2026. But during the depths of 2008, filings reached nearly 938,000 in a single quarter. Today's numbers are nowhere near that level. The broad expert consensus, from Realtor.com to Newsweek to JPMorgan, is the same. Stagnation, not collapse. A slow, frozen market, not a price freefall. But here is the housing impact that almost nobody talks about. A recession does not just change your home's value on paper. It changes your ability to sell at all. When uncertainty spikes, buyers pull back. Sellers who are not forced to sell pull their listings. Transaction volume collapses. The market does not crash. It just stops moving. Existing home sales were already near multi-decade lows, heading into the second half of 2026. A recession pushes activity lower. If you need to sell in a recession because you lost your job, that is the most painful combination in personal finance. Thin buyer pool, time pressure, no leverage to push back on a low offer. For renters watching this, there is an important counterintuitive pattern worth knowing. During the 2008 recession, as home prices fell sharply, rents held or increased in most markets. Displaced homeowners who lost their homes to foreclosure had to live somewhere. That demand flowed into the rental market and kept rents supported even as sales cratered. For potential buyers, a recession scenario could open a window. If the Fed cuts aggressively, mortgage rates fall. If prices dip in your specific local market, your buying power improves. But lending standards tighten simultaneously. Getting approved becomes harder even when rates drop. Your credit score and income stability matter more in a downturn than they do in an expansion. Here is the honest position you want to be in before any of this plays out. First, your emergency fund is not optional. It is the only financial move that protects you across all three areas at the same time. If you lose your job, it keeps you from selling investments at a loss or selling your home under pressure. 6 months of expenses is the real target. 12 if your industry is cyclical. Second, your HISA rate is a floating number, not a fixed return. If the Fed starts cutting, your yield follows within weeks. For money, you will not need for 12 to 18 months. Locking in a CD at today's rates offers certainty a variable account cannot. Third, know your industry's recession profile before you need that information. Healthcare and essential services have historically been more protected. Cyclical and discretionary sectors get hit first and deepest. That knowledge should directly determine how large your savings buffer is. Fourth, on housing, the data does not support panic. But a frozen market with forced selling is its own category of painful. If you have plans to sell in the next 1 to 2 years, your timeline is a real factor. If you are a buyer, rate cuts help affordability, but tighter lending works against you. Credit strength and job stability matter more than the mortgage rate headline in a downturn. Fifth, stop treating your savings, your income, and your home as one single risk category. They are 3 separate systems. They respond to recessions differently on different timelines, with different recovery speeds. Build a financial plan that accounts for all 3. The New York Federal Reserve's yield curve model currently assigns roughly 25% probability of a recession by November 2026. Current prediction market data sits around 12%. Earlier this year, some institutional forecasts were putting that number at 35 to 40%. The range is wide because the inputs are genuinely uncertain. Inflation that reaccelerated to 4.2% in May. A labor market that is steady but not accelerating. A housing market nearly frozen in place. Recession may or may not come. But the preparation math does not change either way. An emergency fund protects you in a recession. It also protects you if you get sick, lose a client, or face an unexpected expense in a perfectly healthy economy. A locked CD rate, a clean credit profile, and a clear picture of your industry exposure are not recession hedges. They are basic financial hygiene that happens to perform extremely well when conditions get hard. The people who get hurt most in recessions are not the ones who panicked. They are the ones who never ran the numbers at all. You just ran them. If this video helped you see your financial picture more clearly, share it with someone who needs to hear it before they need it. Subscribe to The Wealth Metrics. Real numbers, no noise.